financing budgets or financial budgets. The first one we listed actually was capital expenditures budget. We don't have that one illustrated, but what that would do is it would map out your estimated purchases of fixed assets over the next several years, your capital expenditures. So if you're estimating to buy equipment or some vehicles, building, land, anything that's a fixed asset, then you would put that on this capital expenditures budget in the appropriate years, or if you did it just one year, the quarters that you're estimating you would be purchasing those and what the cost would be for each of them. Okay, our focus here is more on the cash budget. This is a vital budget. Cash is so vital. You have to have cash to operate your business and a certain amount of it. So this is the most important financial budget. So we spend more time on this one regardless. There are three main sections on the cash budget. You've got cash receipts, cash disbursements, and financing. Okay, cash receipts are where cash is coming in. You're receiving cash. And this is usually your main source of this is from cash sales and collections from customers on account for your revenues. So again, it's your principal sources of revenue. You could see other things here like receiving of interest or dividends. If you had some sales, maybe you sold some of those fixed assets, or you had stock sales, or you sold some securities or investments. So all of those, again, would be cash receipts. Cash disbursements are showing where you're paying out cash. A lot of these will be your main operating expenses, your production expenses, direct materials, direct labor, and overhead. You'll have all the selling and administrative expenses, but also if you have any dividends that you paid, or you had taxes you paid, or you purchased some investments, you purchased some fixed assets. It's kind of the other side of all the receiving. Almost all, not all. But cash payments, anything you pay cash for. Now, one exception to that would be your financing section. And this shows any expected borrowings and the repayment of those borrowed funds plus interest. So you could see some payments that would be specifically in the financing section, not your disbursements section. But this section is needed when you have any type of cash deficiencies, or when your cash balance is below your minimum requirement or what management has as their lowest acceptable rate of cash. So if they like to see, $10,000 is the lowest amount of cash, then you'd need some financing if you were expecting to go below that $10,000, because you need to keep a minimum balance of a certain amount dictated by management. Okay, if you were deficient, that's where you are in the red, you're negative, so you definitely would need to look at some financing for that to stay afloat. But that's what you'd see in the financing section. So again, any kind of cash receipts section, any kind of payments in the disbursements, unless you're talking about payments for those financing or those borrowings. And then cash receipts for borrowing would also go down there. If you are having to take out a short-term loan, for instance, for cash deficiencies, that would go down in the borrowing section. Or if you were repaying that back, that would also go in the borrowing section. Now, you're going to look through and see different ways you can find out or figure out some of these payments and receipts. For instance, collections from customers. Your cash sales obviously are going to be in the time of the sale. So if in the first quarter you had cash sales, they're all going to be included in the collections there in the receipts section. But your sales on account, as you work through and look at those, they're going to be a little different. Usually you don't expect to get 100% of receivables in the month of the sale. You'll expect a percentage in that month and a percentage in the next month or two, depending on how long you expect to turn around those receivables. And sometimes you may not get all of them back. So receivables, usually you probably don't get 100% of those back. But you'll work through some examples where we'll give you, you had cash sales of this amount, you had total sales on account of, say $50,000. Of the $50,000, half of them are expected to be received in the month of sale, with 30% in the next month and 20% in the following month. So based on that, you can tell me when you should be getting cash in from customers for those. Oops, sorry. All right, let's go to the next slide now. That's your cash. And again, I don't have your capital expenditures up here. It was not illustrated, but it would just be a schedule of expected purchases for capital for, again, things like fixed assets. After you've done that capital expenditures budget and the cash budget, then you could calculate and make up your budgeted balance sheet last. So based on all those operating budgets and now your financing budgets or your financial budgets, you would be able to have all the numbers necessary to make up a budgeted balance sheet. Looks the same as a regular balance sheet, but again, this is budgeted data, not actual. So these are our estimated figures. And a lot of these come from, again, those schedules and other budgets that we've made up previously. For instance, if we just go back to the cash even, you'll see that $37,900, you should see it right there, because that's what you're estimating based on the cash inflow outflows and any financing you're dealing with. How much you expect at the end of the year to have as a cash balance. Well, that would go on your financial statement, obviously. So, again, you'll use this estimated data that you've been compiling to make up this budgeted balance sheet.